Good day and a warm welcome once again. I am your host, Dr. Harshit Simha, and I am delighted to continue from last week's presentation as we further explore the topic, ISSB and the future of global sustainability reporting. The International Sustainability Standards Board, ISSB, represents a transformative milestone in the evolution of global corporate reporting. Established by the IFRS Foundation in November 2021 during COP26 in Glasgow, the ISSB was created to develop a comprehensive global baseline for sustainability-related financial disclosures. Its primary objective is to provide investors, regulators, lenders, and other capital market participants with consistent, comparable, and reliable sustainability information that supports informed decision-making and long-term value creation. Traditionally, sustainability reporting remained fragmented across multiple voluntary frameworks such as DRHs, SASB, TCFD, CDSB, and integrated reporting. This fragmentation often resulted in inconsistency, duplication, and reporting fatigue for organizations operating across multiple jurisdictions. Investors frequently faced challenges in comparing sustainability performance due to the absence of a unified reporting language. The ISSB addresses this gap by consolidating investor-focused sustainability disclosure standards into a single internationally recognized framework. In our previous session, we briefly discussed IFRS S1, IFRS S2, financial materiality, investor-centric reporting, connected reporting, assurance mechanisms, and the broader future of global sustainability reporting. We also touched upon disclosures relating to biodiversity, natural capital, governance, strategy, and risk management. Today, we shall begin with the remaining and equally significant area of human capital disclosures, followed by a deeper discussion on the related dimensions of ISSB implementation and its growing relevance in shaping the future of sustainable and responsible corporate reporting. Slide 2. Human capital disclosures. Human capital disclosures have become a critical component of sustainability reporting under the International Sustainability Standards Board, ISSB, framework. Investors increasingly recognize that an organization's long-term value is closely linked to how effectively it manages its workforce, culture, and talent pipeline. Under IFRS S1, companies are expected to disclose material sustainability-related information that may influence enterprise value, and human capital is one of the most significant areas of focus. The first dimension is workforce composition, which includes diversity, equity, and inclusion metrics. Investors assess gender balance, leadership representation, age diversity, pay equity, and inclusive workplace practices to evaluate governance quality, innovation potential, and organizational resilience. A diverse workforce often reflects stronger adaptability and decision-making capacity. The second area is labor practices, covering employee health and safety, fair wages, ethical labor conditions, and workforce well-being across the entire value chain. This extends beyond direct employees to contractors and suppliers. Poor labor practices may create legal, regulatory, and reputational risks that can directly affect profitability and investor confidence. The third aspect is talent and skills development. Organizations must demonstrate how they attract, retain, and develop talent necessary for future growth. This includes employee training, succession planning, leadership development, and retention strategies. ISSB treats these disclosures not as social responsibility narratives but as financially material information. Strong human capital management supports productivity, innovation, operational continuity, and strategic execution. Therefore, investors increasingly view workforce quality as a core indicator of sustainable long-term business performance. Slide 3. About data quality and estimation with qualitative characteristic of ISSB disclosure. The usefulness of sustainability disclosures depends not only on the information reported but also on the quality of that information. ISSB standards emphasize qualitative characteristics that ensure disclosures are credible, transparent, and decision useful for investors. These principles form the foundation of effective sustainability reporting. The first characteristic is relevance. Information must be capable of influencing investor decisions by helping them assess sustainability-related risks and opportunities that affect enterprise value. Reporting should focus on material matters rather than excessive or immaterial disclosures. The second is faithful representation. Sustainability disclosures must be complete, neutral, and free from material error. Companies should avoid selective reporting or promotional narratives. Investors require balanced disclosure of both strengths and vulnerabilities. The third characteristic is comparability. Consistent application of ISSB standards enables investors to compare performance across companies, industries, and reporting periods. Without comparability, sustainability data loses much of its strategic value. The fourth is verifiability. Independent reviewers should be able to assess whether reported information accurately reflects reality. This strengthens trust and supports external assurance processes. A major challenge lies in data quality and estimation, especially for complex areas such as Scope 3 greenhouse gas emissions across value chains. ISSB acknowledges that precise measurement may not always be possible and therefore allows estimation techniques. However, organizations must clearly disclose the methods, assumptions, and limitations used. High-quality sustainability reporting is not about perfection, it is about disciplined transparency. Reliable disclosures improve investor confidence and ensure sustainability reporting serves as a credible extension of financial reporting rather than a separate communication exercise. Slide 4. Implementation challenges and role of the CFO. Implementing ISSB standards presents significant challenges for organizations, particularly those operating across complex global value chains. While the framework provides a strong global baseline for sustainability reporting, successful adoption requires substantial operational, financial, and strategic transformation. The first challenge is data availability. Sustainability information such as emissions data, labor practices, and supplier performance is often fragmented, inconsistent, or unavailable. Scope 3 emissions reporting is especially difficult because it depends heavily on external stakeholders across the value chain. The second challenge is skills and expertise. Many organizations lack professionals who can bridge both sustainability knowledge and financial reporting discipline. Finance teams may not fully understand ESG reporting, while sustainability teams may lack financial reporting rigor. This creates a need for cross-functional collaboration and significant training investment. The third challenge is system integration. Sustainability reporting must be connected with financial reporting systems rather than managed separately. This requires integration of ESG data into enterprise systems, internal controls, and governance frameworks, often involving major technology investments. In this environment, the Chief Financial Officer plays a central role. CFOs ensure financial integration by aligning sustainability disclosures with financial statements and enterprise value creation. They establish strong data governance through controls, verification, and reporting disciplines similar to financial audits. CFOs also lead investor communication by explaining sustainability risks, opportunities, and performance transparently to capital markets. Their leadership ensures that sustainability disclosures are treated with the same seriousness as financial reporting, making them essential to successful ISSB implementation. Slide 5. Connected reporting and benefits of ISSB adoption. ISSB reporting creates the greatest value when sustainability disclosures are fully integrated into connected reporting rather than presented as isolated reports. Connected reporting links sustainability performance directly with financial outcomes, strategic decision-making, and investor communication, creating a more complete view of enterprise value. The first element is the sustainability report, which includes ISSB-aligned disclosures on governance, strategy, risk management, and sustainability-related metrics and targets. It explains how environmental and social factors influence business performance. The second element is financial statements, where quantified financial impacts of sustainability risks and opportunities are reflected. Climate risks, for example, may affect asset impairment, provisions, capital expenditure, and long-term financial planning. The third component is management commentary, which provides narrative context linking sustainability strategy with operational performance and future business direction. This helps investors understand the strategic significance of reported data. The fourth is investor relations, where companies communicate transparently with capital markets regarding ESG performance, resilience, and future transition plans. The benefits of ISSB adoption are substantial. First, investor confidence improves because consistent and comparable disclosures reduce uncertainty and build trust. Second, early adopters gain competitive advantage by attracting ESG-focused investors and strengthening market reputation. Third, better risk management emerges because ISSB reporting requires companies to systematically identify and manage sustainability risks. Ultimately, connected reporting transforms sustainability from a compliance obligation into a strategic management tool. It strengthens transparency, improves capital access, and positions organizations for long-term resilience and sustainable value creation. Slide 6. Transition relief provisions. Recognizing the practical challenges of adopting new sustainability reporting standards, the ISSB introduced transition relief provisions to support organizations during the early stages of implementation. These temporary measures help companies begin reporting under IFRS S1 and IFRS S2 without facing immediate full compliance pressure. The first provision is Year 1 comparative relief. In the initial year of application, companies are not required to present comparative information for the prior reporting period. This reduces the burden of reconstructing historical sustainability data that may not have been collected using ISSB methodologies. The second provision is the Scope 3 emissions deferral. Organizations may delay reporting Scope 3 greenhouse gas emissions for 1 year after first applying IFRS S2. Since Scope 3 covers indirect emissions across suppliers, logistics, customers, and other external partners, data collection is often highly complex and difficult to verify. The third provision is timing relief. During the first year, companies may publish sustainability disclosures after the release of financial statements if necessary. This acknowledges that many organizations require additional time to establish reporting systems, governance structures, and assurance readiness. These relief measures are designed to encourage adoption while maintaining long-term reporting quality. They are not permanent exemptions but practical transition mechanisms that allow companies to build internal capability progressively. Organizations should use the key transition relief related to Scope 3 where it is not mandatory to disclose about Scope 3 during the first year of application, followed by dealing comparative information that too is not compulsory the first year of applying IFRS S1 and S2. The time flexibility whether entities are required to publish sustainability disclosures after the related financial statements in the first year and when taking account of S1 deferral, entities applying IFRS S2 for the first time may defer application of IFRS S1 for 1 year improving data systems, training teams, and preparing for future assurance requirements. The ISSB's message is clear: begin now, improve continuously, and move steadily toward full investor-grade sustainability reporting. Slide 7. Technology and ISSB implementation. Technology has become a fundamental enabler of effective ISSB implementation, particularly under IFRS S1 and IFRS S2, where sustainability disclosures require the same level of discipline, accuracy, and assurance as financial reporting. Traditional manual methods and spreadsheet-based reporting are no longer sufficient to manage the complexity of sustainability data across modern enterprises. A key requirement is centralized ESG data management. Sustainability information is typically scattered across finance, operations, procurement, human resources, and supply chain functions. Without integrated systems, data becomes fragmented, inconsistent, and difficult to verify. ESG data platforms help consolidate this information, enabling organizations to maintain consistency and reporting integrity. Carbon accounting software is especially important for climate-related disclosures under IFRS S2. Companies must accurately track Scope 1, Scope 2, and Scope 3 greenhouse gas emissions. Scope 3 reporting, in particular, involves extensive supplier and value chain data, making automated systems essential for precision and audit readiness. Integrated reporting tools also ensure alignment between sustainability metrics and financial reporting processes. Since ISSB disclosures are based on financial materiality, sustainability data must connect directly with enterprise value, risk management, and capital allocation decisions. Technology further strengthens internal controls, workflow approvals, documentation, and assurance preparedness. Advanced tools such as artificial intelligence and predictive analytics also support climate scenario analysis and forward-looking risk assessments. Ultimately, technology is not merely a compliance solution, it is a strategic investment. Organizations that build robust digital infrastructure early will improve disclosure quality, reduce reporting costs, and strengthen investor confidence in an increasingly data-driven sustainability environment. Slide 8. ISSB and Sustainable Finance. The ISSB standards serve as a critical foundation for the global sustainable finance ecosystem. Sustainable finance refers to investment and lending decisions that integrate environmental, social, and governance considerations into capital allocation. Without reliable and comparable sustainability disclosures, investors cannot make informed decisions regarding long-term value creation and responsible investment. ISSB provides investor-grade sustainability information that enhances transparency and reduces the risk of greenwashing. This is particularly important in financial instruments such as green bonds, where investors require confidence that funds are genuinely supporting environmentally beneficial projects such as renewable energy, energy efficiency, or climate adaptation. Sustainability-linked loans also depend heavily on credible disclosures. These financing instruments connect borrowing costs to measurable sustainability targets, such as emissions reductions, diversity improvements, or water conservation goals. ISSB reporting ensures these targets are transparent, measurable, and independently verifiable. ESG indices used by institutional investors also benefit significantly. Pension funds, sovereign wealth funds, and asset managers rely on these indices to screen companies and guide portfolio decisions. Standardized disclosures improve the consistency and reliability of ESG ratings, reducing confusion created by fragmented reporting frameworks. Responsible investment strategies such as stewardship and shareholder engagement are strengthened as investors gain clearer visibility into climate risks, governance quality, and transition planning. Above all, sustainable finance requires trusted information infrastructure. ISSB transforms sustainability reporting from voluntary narrative disclosure into formal capital market intelligence. It ensures that capital flows toward companies that genuinely manage sustainability risks and opportunities with transparency, discipline, and long-term strategic vision. Slide 9. The ISSB Work Program. The ISSB Work Program reflects a long-term commitment to building a comprehensive global baseline for sustainability disclosures that extends far beyond climate reporting. While IFRS S1 and IFRS S2 established the foundation for general sustainability and climate-related reporting, the board's broader agenda addresses a wider range of financially material ESG issues. Climate was addressed first because it represents the most urgent and globally recognized sustainability challenge with significant financial implications. However, investors increasingly require disclosures on additional sustainability topics that directly influence enterprise value and long-term resilience. One major future priority is biodiversity and ecosystem services. Risks such as deforestation, water scarcity, biodiversity loss, and ecosystem degradation can significantly affect sectors such as agriculture, manufacturing, mining, and infrastructure. Investors need greater visibility into how these nature-related risks influence corporate strategy and financial performance. Human capital is another important area of development. Workforce resilience, labor practices, employee well-being, diversity, and talent development are increasingly viewed as critical drivers of operational continuity and long-term competitiveness. Human rights disclosures are also gaining prominence, particularly within global supply chains. Issues such as forced labor, community displacement, indigenous rights, and social license to operate carry substantial legal, reputational, and financial consequences. The ISSB is developing these standards through research, stakeholder engagement, and collaboration with global regulators to ensure consistency and avoid duplication. The long-term vision is a complete suite of sustainability disclosure standards with financial materiality at its core. This signals that sustainability reporting is evolving into a structured discipline equal in importance to traditional financial reporting. Slide 10. Preparing for ISSB compliance and its readiness roadmap. Organizations should begin preparing for ISSB compliance well before regulatory mandates make adoption compulsory. Early readiness reduces implementation costs, improves data quality, and strengthens investor confidence. Sustainability reporting is rapidly becoming a market expectation rather than a voluntary initiative. The first step in the readiness roadmap is gap assessment. Companies must compare existing sustainability reporting practices with the requirements of IFRS S1 and IFRS S2. This helps identify missing disclosures, governance weaknesses, inadequate controls, and data limitations. A clear gap analysis creates the foundation for strategic implementation. The second step is data infrastructure development. Organizations need reliable systems for collecting, validating, and consolidating sustainability data, including emissions, climate risks, workforce metrics, and supply chain information. Strong data architecture improves consistency and assurance readiness. The third step is governance setup. Effective ISSB reporting requires clear board oversight and management accountability. Responsibilities must be defined across the board, audit committees, CFOs, sustainability leaders, and operational teams. Strong governance ensures sustainability reporting is treated with the same seriousness as financial reporting. And lastly, the fourth step is disclosure preparation. Companies should begin drafting ISSB-aligned disclosures early, even on an internal basis, to test processes, identify weaknesses, and improve reporting quality before formal publication. A structured readiness approach transforms compliance into strategic advantage. Early adopters benefit from stronger investor trust, better operational control, and improved access to sustainable finance. ISSB readiness is therefore not simply regulatory preparation, it is a long-term investment in resilience, credibility, and future competitiveness. Slide 11. The assurance ecosystem and its requirements. As ISSB standards become mandatory across global markets, assurance is emerging as a critical pillar of credible sustainability reporting. Investors require more than disclosures, they require confidence that the reported information is accurate, reliable, and independently verified. This is where the sustainability assurance ecosystem becomes essential. The assurance ecosystem includes audit firms, specialist assurance providers, regulators, professional bodies, and standard-setting institutions. Together, they create the frameworks and competencies necessary to validate sustainability disclosures prepared under IFRS S1 and IFRS S2. The first stage is disclosure preparation. Companies must establish robust internal controls, governance structures, and documentation processes before seeking external assurance. Without strong internal systems, assurance becomes inefficient and costly. The second stage is limited assurance, which is typically the initial level of external review. Here, an independent third party assesses whether anything has come to their attention indicating material misstatement. It provides moderate confidence and is often the first regulatory requirement for sustainability disclosures. The third stage is reasonable assurance, which represents a higher standard similar to financial statement audits. It requires deeper testing, stronger evidence, and greater confidence in internal controls and data quality. Moving from limited to reasonable assurance demands significant organizational maturity. Companies must treat sustainability data with the same rigor as financial information. Assurance reduces greenwashing concerns, strengthens investor trust, and improves access to sustainable finance. It transforms sustainability reporting from a narrative exercise into audit-ready corporate disclosure. In the future, assurance will no longer be optional. It will be a fundamental expectation of investor-focused sustainability reporting under the ISSB framework. Slide 12. Impact on capital allocation. The adoption of ISSB standards has a profound influence on global capital allocation by improving the quality, consistency, and comparability of sustainability disclosures. Investors today evaluate companies not only on traditional financial performance but also on their ability to manage environmental, social, and governance risks that affect long-term enterprise value. ISSB disclosures provide the standardized information necessary for these strategic investment decisions. One major area of impact is ESG indices. Institutional investors such as pension funds, sovereign wealth funds, and asset managers rely on ESG ratings and indices to screen companies, construct portfolios, and determine investment weightings. Consistent ISSB-aligned disclosures improve the reliability of these ratings and reduce confusion caused by fragmented reporting standards. Green finance is another important dimension. Financial instruments such as green bonds, sustainability-linked loans, and transition finance depend on transparent and measurable sustainability disclosures. Investors require confidence that capital is genuinely supporting climate mitigation, adaptation, and responsible business transformation. ISSB strengthens this trust through investor-grade reporting. Stewardship also becomes more effective. Shareholders increasingly engage with boards and management on climate strategy, emissions reduction targets, governance quality, and transition planning. ISSB disclosures provide the evidence base for informed engagement and stronger board accountability. Improved disclosure reduces information asymmetry, strengthens pricing efficiency, and may lower the cost of capital for companies with credible sustainability performance. Ultimately, ISSB ensures that financial markets reward organizations capable of managing sustainability risks responsibly, supporting a more resilient and sustainable global economy. Slide 13. Key takeaways. The ISSB framework represents one of the most significant advancements in the evolution of corporate sustainability reporting. Several key takeaways explain why IFRS S1 and IFRS S2 are reshaping global reporting expectations and investor decision-making. The first key takeaway is the establishment of a global baseline. For the first time, companies and investors have access to a common international framework for sustainability disclosures. This reduces fragmentation caused by multiple voluntary standards and improves consistency across jurisdictions and industries. Global comparability is essential for efficient capital markets. The second is financial materiality. ISSB focuses specifically on sustainability matters that may reasonably affect enterprise value and investor decisions. This means disclosures must be directly linked to financial performance, strategic planning, risk management, and long-term valuation. Sustainability reporting is therefore integrated into mainstream business reporting rather than treated as a separate exercise. The third takeaway is climate first. IFRS 2 addresses climate-related disclosures because climate risk remains the most urgent and financially material sustainability issue globally. Governance, strategy, risk management, and climate-related metrics must be disclosed with increasing discipline and transparency. The fourth and perhaps most important takeaway is the need to act now. Organizations should not wait for legal mandates before beginning preparation. Investors, lenders, regulators, and customers already expect stronger sustainability disclosures. ISSB is not simply another reporting framework. It marks the beginning of a structural transformation where sustainability reporting becomes business reporting, and early preparation becomes a strategic advantage for long-term market leadership. Slide 14. Future ISSB Standards. The future development of ISSB standards demonstrates that sustainability reporting is only at the beginning of a much larger global transformation. IFRS 1 and IFRS 2 are the starting point, but the long-term objective is to create a complete suite of investor-focused disclosure standards covering all major ESG topics. The journey began in 2023 with the issuance of IFRS 1 and IFRS 2, establishing the first global baseline for general sustainability and climate-related disclosures. These standards created the foundation for consistent, investor-centric reporting across jurisdictions. During 2024 and 2025, the ISSB initiated research projects on biodiversity, ecosystems, and ecosystem services. Nature-related risks such as deforestation, water scarcity, biodiversity loss, and ecological degradation are becoming increasingly material for sectors such as agriculture, infrastructure, mining, and manufacturing. Investors require better visibility into how these issues affect financial resilience. Between 2025 and 2026, attention is expected to expand toward human capital and human rights disclosures. Workforce resilience, labor standards, diversity, employee well-being, supply chain ethics, and community impacts are increasingly viewed as critical to enterprise value and long-term competitiveness. From 2027 onward, a broader suite of ISSB standards is expected to emerge, covering wider environmental and social themes while maintaining financial materiality as the guiding principle. This roadmap confirms that sustainability reporting will become more comprehensive, regulated, and integrated with financial reporting. Organizations that build capability early will be better prepared to adapt, while those treating ISSB as a short-term compliance exercise may face significant strategic disadvantages. Slide 15. The future of sustainability reporting. The ISSB represents a historic turning point in corporate reporting by bringing sustainability and financial reporting into one integrated framework. For decades, financial reporting focused primarily on historical performance, while sustainability reporting often remained voluntary and disconnected from investor decision-making. ISSB changes this fundamentally. For the first time, investors around the world can access sustainability information that is consistent, comparable, reliable, and financially relevant. This improves market efficiency by enabling capital to be allocated based on a clearer understanding of long-term risks and opportunities. The ISSB's IFRS 1 and IFRS 2 standards mark the beginning of a new era in corporate disclosure where sustainability reporting and financial reporting function as one integrated system. This is not merely a reporting reform, it is a transformation in how business value is understood, measured, and communicated. Climate change, biodiversity loss, supply chain disruption, labor practices, and governance failures all have direct financial consequences. ISSB ensures these issues are disclosed with the same seriousness and discipline as traditional financial matters. This strengthens accountability and reduces the risk of greenwashing. For businesses, sustainability can no longer be treated as a separate corporate social responsibility initiative. It must be embedded into governance, strategy, risk management, and investment decisions. Boards, CFOs, audit committees, and investor relations teams all become central to sustainability oversight. For investors, ISSB provides stronger tools to evaluate resilience, transition readiness, and stewardship quality. For society, it enables capital to flow toward organizations supporting a low-carbon, inclusive, and resilient economy. The future of sustainability reporting is therefore not about producing larger reports, but about making better strategic decisions. ISSB is building the foundation for a reporting system where sustainability and financial performance operate as one unified language of enterprise value. Here, we bring the present discussion to a close. However, this certainly does not mark the end of our journey into the evolving landscape of sustainability disclosure frameworks. Beginning next week, we shall move forward with a new and equally significant framework, the Sustainability Accounting Standards Board, SASB standards. The SASB standards place strong emphasis on industry-specific ESG disclosure requirements, with a clear focus on financial materiality for investors. These standards are designed to help organizations identify and report the sustainability issues most relevant to enterprise value creation within specific industries. With their consolidation under the ISSB framework, SASB continues to play a critical role in strengthening investor-centric sustainability reporting and enhancing global comparability. We encourage you to remain actively engaged with our channel, participate in the forthcoming sessions, and thoughtfully share these professional insights across your networks, particularly among business leaders, sustainability practitioners, compliance professionals, and stakeholders committed to advancing responsible corporate governance and transparent reporting practices. The transition toward integrated sustainability reporting is not merely a regulatory expectation. It is a strategic imperative for building resilient, accountable, and future-ready enterprises. Until then, we extend our sincere regards and appreciation for your continued association, and we look forward to welcoming you again in the next session as we continue this important journey towards stronger sustainability leadership and reporting excellence.